All right, thank you so much for the opportunity to discuss this paper. I learned a lot. I know a thing or two about models of debt structure, so I thought a preliminary reading suggested that maybe I'm a appropriate discussant. Turns out that I'll actually not focus. I won't focus on that. So we'll see how it goes. So this is a paper about financially sophisticated firms. So essentially, the observation is that firms issue different types of bonds, and the argument is that they do this to reduce their financing costs and diversify funding sources. So they're financially sophisticated in the sense that they're supplying assets in high demand while minimizing funding risk. There's a few facts, and Kerry did a terrific job at presenting the results, so I'll be quick here. Firms issue multiple types of bond types. Different investors invest in different bond types, mostly mutual funds versus insurers is what we're looking at here. Firms with different bond types have a lower funding risk. And then there's a model. The model predicts that investor preferences affect credit spreads, and there's some empirical evidence on that, of a 2 basis points reduction in the credit spreads. And that in turn then affects issuance by about 3%. Funding risk reduces issuance of bonds by about 0.5%. And firms' ability to issue multiple bond types creates value, about 1.4 basis points over a 2-day window. So the interpretation then of this is that firms act as financial intermediaries and actively complete markets. I want to talk briefly about financial sophistication, then the various bond types that are being used, investors and flows, and then very briefly about the model and the evidence. So financial sophistication, typically we think of financial sophistication as in the household finance context. Galvez, Campbell, and Sodini define financial sophistication as the ability of households to avoid making investment mistakes. So specifically, what kind of mistakes do people avoid? Financially sophisticated households participate in stock markets, they diversify, they rebalance, they refinance. So the basic pattern is financial sophistication increases with financial wealth, household size, education. So here we're talking about financial sophistication of firms, obviously a catchy title. A bit of a stretch, we're talking about very large firms. These are firms that are participating in bond markets. And the paper is not entirely clear whether they're thinking that even within that class, some are sophisticated, others are not. There seems to be some, the reader is a little bit led to believe that firms that issue only one bond type are not sophisticated. And so I want to briefly debate that. But although the paper is not super clear, you can read the paper also saying all firms that participate in bond markets are financially sophisticated, and I'll agree with that. So just to give you a sense in terms of financial sophistication, so early refinancing, so Campbell, one thing that is pointed out is that prompt refinancing requires financial sophistication. In fact, more educated, higher income higher home value households are more likely to refinance. When you actually look at this in the data in the bond market, it is actually the high yield firms that refinance early. You see here a picture of high-yield firms and investment-grade firms, and high-yield firms essentially finance a substantial part, roughly 50 to 70% into the maturity of their bonds, whereas the investment-grade bonds essentially are refinanced early, only to a very limited extent. So investment-grade firms then essentially don't refinance early. By that metric, it would look like actually certainly high-yield firms or firms that issue high-yield bonds, which typically, by the way, have one bond type. 80% of the firms that issue only one bond type in the data, in Kerry's data, are high-yield. But they're certainly sophisticated from the vantage point of refinancing early. The refinancing behavior then is also very related to the credit spread. So there's substantial variation in high-yield refinancing by financing conditions, and very little variation for investment-grade firms. So in this sense, even high-yield firms that issue only one bond type seem to actually be quite sophisticated. And by the way, keep in mind this relation with the credit spread when we are thinking about the exogenous, when we're constructing measures of exogenous flows. So then we're constructing different bond types by ratings, by maturity, by size, by covenants, by redemption options. And there, the paper doesn't exactly say which redemption options are considered, but and that gives you 3 by 3 by 2 by 2 by 2, so 72 different bond types. Okay, and that is then a little bit collapsed to 60. One question is like exactly how do we come up with these particular characteristics? They're not implausible, but I'm going to argue that some of them are maybe more plausible than others. And then there's another question is how are the cutoffs computed? In terms of one question to me is what are characteristics, what are choices? To me, ratings at this broad bucket level is really a characteristic, not a choice. And I was wondering whether that's consequential for the analysis. In fact, at this level of course buckets, only 6% of firms have bonds in multiple rating categories. Okay, so essentially, if you have low net worth, you're a high-yield firm, and you're going to be a high-yield firm. It's not the choice to issue AAA-rated debt. Maturity and size seem to be a choice. 53% of the firms have bonds in multiple maturity buckets, and then 37% in different size buckets. One thing that's not considered, and that, surprise to you probably, is dear to my heart, is collateral. So the choice of whether it's secured or unsecured is both, in my view, a choice. I have some papers on that structure, on secured versus unsecured, and I think actually it would be useful to take that into account. Securing can affect the credit rating by a notch or two. All right, so maturity is a choice, I said, but here again, there's something interesting from a more corporate finance perspective, which is when you look at the investment grade firms, they have maturities up to 15 years, 30 years or more, whereas among the high yield bonds, essentially maturities larger than 10 years are very rare. Here, there's one thing that is settled, which is the slides actually were slightly different from what was in the paper. I think the maturity buckets that are being used, first, are the same for IG and high yield. And second, at least in the paper, they were presented as open at the top. You see that's consequent. That might potentially be consequential because in the speculative grade, essentially almost everything is 10 years and below. So where you put the 10 years actually does matter for whether or not you have buckets, have high yield bonds in a long maturity bucket. I would think the ones that are closed above would essentially show that long maturities are essentially not an option for high-yield firms. So there's a bit of a corporate finance reason potentially for this, and I personally would adjust the maturity buckets if they haven't already been adjusted. Then there's an aspect of size. Size is a choice. And then there's a question, is it actually more costly to issue multiple smaller issues? There's a job market paper out of Wisconsin this year, Coyle, who looks at underwriter spreads and sees them, or provides evidence that they decrease quite sizably, actually by a factor 2, 40 basis points across bond size issues. So actually by issuing more bonds that are smaller than, that might actually be very quite costly. And so that would be interesting to think about. This issue of secure versus unsecured comes up. Here's a recent transaction from this week in the bond market. DirecTV issued about $2 billion of 6-year, 10% senior secured notes. DirecTV is a high-yield firm, so issuing less than 10-year debt. They actually concurrently issue a term loan B of about $600 million. They had adjusted the size within the day between the bond and the term loan. They refinanced, interestingly, about $400 million of a note that was coming due in 2027. That's 2 years from now, that actually had an interest rate of 5.875%, and they secured it, which actually gave at least Fitch rated it BBB minus, so just barely investment grade. A couple of things here. First, we're considering here the bond structure in isolation, but there's a very clear and direct substitution to the loan structure, so that's interesting and might be worth considering. Here, and this firm, if I read this correctly, is paying more than 4% to refund, to refinance that note that matures in 2027 early. That's massive, and it secures it to increase. At least for Fitch, all the other ratings are still high yield, but at least Fitch pushes it over the edge for investment grade. This is ADT, just to show you again like how this works in practice. When you look, this is the the bonds outstanding from the most recent 10K of ADT. They actually have essentially a laddered bond structure with maturities 24, 26, 27, 29. And then in 2023, they refinanced a term loan that was due in 2026 with one that matures in 2030. So it's a laddered bond and debt structure. They are refinancing early, 2 to 3 years, and a lot of this is secured. All right, so all of these corporate finance factors, I think it might be useful to take into account. Let me briefly talk about the investors. So the investors and flows, so we're looking at mutual funds and insurers. These guys hold about 37% of corporate bonds. In total, that's a sizable fraction of the market, but obviously not the entire market. Of these bonds, 41% are held by mutual funds and 59% by insurers. The mutual funds hold 78% of high-yield bonds. So that's the specialization that Kerry was talking about, and mostly in what is categorized in the paper as high-yield mutual funds. So essentially, high-yield mutual funds, they go into high-yield bonds go into high-yield mutual funds. Insurers, on the other hand, buy 71% of the long-term debt, more than 10 years. They buy 72% of the small issues, and that is mostly the life insurers that buy this. So essentially, to me, essentially what the way this looks like, if you're a high-yield firm, there's really no choice for you. You're going to issue, if you issue bonds, they're going to be high yield, and they're going to go into high-yield mutual funds. If you're an IG, on the other hand, you have a choice. If you're choosing to issue long-term bonds, larger than 10 years, they're attractive to life insurers who are looking for duration. And so, and if you issue shorter-term bonds, essentially, you can sell them to anyone. So it might be useful then to distinguish between high yield and IG issuers, to either deal with them separately or focus more specifically on the IG issuers. There's a few minor comments that I thought were curious, but I will skip them. Well, maybe one thing I'll say. Currently, there's a very high demand from life insurers for long-term bonds, and that might, in fact, be one of the reasons why corporate bond spreads are quite compressed as they are right now. The other thing I wanted to say about investors and flows is that, so what we do is we compute these exogenous flows by looking at the residuals of a regression. The controls are the returns of the funds, the VIX, the market index, and fund fixed effects. I would think, since we're thinking about the bond market, I would include some term structure factors, short rate, long rate, credit spread in particular, given what we saw earlier about the high yield credit spread being very consequential. The other thing I wanted to say is that the variance covariance matrix is in the paper. I translated it into a correlation matrix, which helped me more. The flows, I dropped the high yield short-term thing, mutual funds, because they're just tiny, but they're very highly correlated among the various mutual funds. So that's, I wanted to observe that, and I was thinking about whether that was consequential. I think Peter tells me I have 1 minute. Is that right? Okay. The model is static, which is fine, but it's GE, which is nice. The firms are essentially unconstrained, and so essentially they're arbitrageurs. Let me just make one point. So then there's these predictions that Kerry highlighted. In the model, in some sense, actually what is emphasized is a funding risk affects issuance, credit spreads affect issuance, but the trade-off that between funding source and funding risk doesn't really come doesn't come out as crisply as you might like. The narrative in the paper is at times a little bit like, by issuing many type of firms both reduce their funding risk and reduce the funding cost. And I think it would be more of a trade-off, and I would like to see more fleshed out like how this trade-off is resolved. I also, in the model, the way funding risk is measured is modeled, is very reduced form. I was writing a model that was a bit more explicit about the funding risk, but it got late last night, so I didn't include it here. Plus, I'm out of time. So I have a couple of things about the empirical work. Maybe I'll just say one thing. It looks to me like the magnitudes are small, perhaps that plausibly so, but I just want to make sure that that's the correct reading. Super interesting paper about corporate bond structure. Again, I would like to see that trade-off between funding risk and pricing to emerge more crisply, and maybe a pinch of corporate finance would help guide the analysis. Thank you.
Thanks, Adriano.